Well, good afternoon and welcome. My name is Joe Swimmer. I'm the Executive Director of Episcopal Parish Network, and we're pleased to welcome you today to this session on fiduciary and endowment management best practices, governance, fiduciary duty, responsibilities that you might have in your parish or cathedral. This is a wonderful group of experts that we have assembled from our partners at CAPTRUST to help walk through some of the things that you should be thinking about if you have a senior leadership role in your parish or your cathedral. We're going to ask that you use the chat to put in questions or comments during the session. And also, please, if you will take a minute and put in where you're dialing in from, that would be terrific, just so our panelists have a sense of where in the country their listeners are coming from. If you are not a member of Episcopal Parish Network, I invite you to learn more by going to the link that is in the chat. We host digital workshops like this that help to strengthen parish ministry across the country, and we'd love to have your support in that work, as well as, of course, our conference, which our friends at CAPTRUST will be at in Houston next March 6th through 9th, and a variety of other things. But I've said enough. Welcome. We're glad to have you. And we are so pleased to have our friends from CAPTRUST leading this session. And now I'm going to turn it over to Dave. Dave, all to you.
Joe, thank you so much. We are delighted to be here this afternoon with members of the EPN network and partnering with you on this. My name is David Hanson, and I'm joined today by my CAPTRUST colleagues, Heather Shanahan and Bill Paxton. Heather is the Director of Endowments and Foundations for CAPTRUST, and she's in Raleigh, North Carolina. My colleague Bill is a principal and lives in Lynchburg, Virginia, and I reside in Lexington, Virginia, in the beautiful Shenandoah Valley. I thought it might be helpful to provide a bit of an overview of our time together today so we can make it as helpful as possible. Heather, could you give us the next slide? So first, Heather is going to provide a little bit of an overview on CAPTRUST, so you have a little more information about who is talking to you. Then Bill is going to cover the ideas and information in UPMIFA and fiduciary responsibilities. Then I will spend a few minutes talking about investment policy statements and some of the things that go into them. And then finally, we will have time for Q&A. And as Joe mentioned along the way, you can put questions in the chat if things occur to you, and then we can address them at the end. In the housekeeping department, I think we're scheduled to go about an hour before Joe gives us the hook. And so with that, Heather, could you show the next slide? I just want to make one quick comment here before Bill gets going, which is you can see we're talking to vestry, committee, and trustee members. We have tried to think about the various constituencies out there, and we have tried to have kind of an in the trenches approach to this in a personal capacity. I serve as chairman of our parish's investment committee, and also this year in a personal capacity, I'm the president of our diocesan trustees of the funds. So we are kind of out there seeing the issues that you are wrestling with on a daily basis and are trying to be relevant there. With that, Heather, maybe you can provide a little background information on CAPTRUST.
Thank you, Dave. It's a pleasure joining you today. I'll be brief as we want to get to the rest of our content, but I think it's helpful from a context standpoint. So CAPTRUST is headquartered in Raleigh, North Carolina, where I am. We've been around for 37 years. We have been recognized as the largest registered investment advisory firm for 8 years running, so largest in the United States. We are extremely proud of that number on the bottom, the 98% client retention number. So we are grateful for the fact that CAPTRUST clients tend to stay CAPTRUST clients. We have over 3,500 institutional clients, which is the category that endowments and foundations fall under for us. And in general, a third of our clients are nonprofits. So we are heavily committed to this space. We are majority employee owned, so we think that impacts everything that we do as well. So we are extremely committed to the client experience. We sit on the same side of the table as our clients, and serve as good stewards in all things. In terms of the endowment and foundation practice specifically, we have about 22 billion in assets under management in this arena, about 524 endowment and foundation clients. We do a tremendous amount of work with religious services clients, so clients who are Episcopal clients, all denominations. And as I said, a third of the institutional clients that we serve are nonprofits, and the average account size is 41 million, but you know what they say about averages, a foot in a bucket of cold and a foot in a bucket of warm, and you're supposed to feel okay. But the reality is we serve a tremendous number of smaller clients as well. Our range tends to be 5 to 250 million, but we also have a lot of clients that are under 5 million. We spend a lot of time focusing on our clients' needs in addition to the investment management conversation, and that is part of what we are covering today. So we look at our nonprofit service work in 3 pillars: the investment management story, fiduciary governance, and mission engagement. So this falls under mission engagement. Falls under fiduciary governance. And we'll look forward to spending time with you on this today. Talked a little bit about how we help, in addition to the endowment foundation practice, we also manage a tremendous number of retirement plans as well as individual planning with wealth clients too. What makes us different? I kind of want to jump to the bottom left of your screen there, giving back to local communities we serve. We have our own community foundation. So we have our own nonprofit embedded within CAPTRUST, and our mission is to serve children, typically children in crisis, in the communities where we serve. We have 76 offices across the country. So we kind of experience the joys and challenges that any other nonprofit organization does. We have tremendous expertise. We try to be timely with our content. I host a webcast called Mission and Markets. And so this one that we just rolled out today talks about tax planning with a CPA and auditor who's focused exclusively on nonprofits. We've talked about CEO transition. We will be talking about community foundations next month. So timely topics, hopefully you'll join in, but everything we do is focused on providing value to our clients. And I will turn it over to Bill for a little bit more information about UPMIFA.
All right. Thanks, Heather. And thanks, Joe and EPN, for the opportunity for us to talk to you all today. So I'm going to talk a little bit about UPMIFA. Heather, you can go ahead to the next slide. Many of you all may be familiar with the Uniform Prudent Management of Institutional Funds Act, UPMIFA, which was developed originally in 2006 by the nonpartisan National Conference of Commissioners on Uniform State Laws. And we know that that commission is nonpartisan because the name of the act actually tells you what it's about, unlike what tends to come out of Washington. Not a political comment, but anyway, so UPMIFA provides guidance to nonprofits for the prudent and effective management and investment of endowment funds. And really the way to think about the act is as a fiduciary best practice manual and safe harbor for fiduciary liability as relates to endowment funds. The act has been adopted in all 50 states except for Pennsylvania, which does have its own version similar to UPMIFA. And the act applies to most, but not all endowment funds. There are some discrete exceptions, but again, we do think it's best to think about it as a sort of a best practice manual and a safe harbor for fiduciary liability. And UPMIFA really does 4 things. First, it imposes a legal duty of care on those who are responsible for managing and investing charitable assets. Second, it provides guidelines and standards for investing endowment funds held by charitable organizations. More on that in a minute. Third, it creates a framework governing expenditures of endowment funds, spending policies. And it does that really by balancing two overriding goals, to preserve endowment funds for their intended purpose, long-term in most cases. And then secondly, to give primary consideration to the donor intent. And UPMIFA provides much greater flexibility on spending from endowment funds than the law that predated it. And then fourth, UPMIFA provides clarity on the release or modification of restricted assets. The law really incorporates a trust law concept called C-PRE, which allows for the release of restrictions on restricted funds if the size, fund purpose, or donor restrictions make it have gotten to where it's impractical or wasteful to continue to follow the original intent of those funds. And in most states, there are three ways to release or modify restricted assets. First, through written consent of the donor. Secondly, court approval. And then finally, consent of the state's attorney general. So Heather, if you'll advance to the next slide. Going to talk just for a minute or two about UPMIFA's standard of care, and the Act does prescribe a standard of care that nonprofits, including churches, should exercise. And that standard is ordinary business care and prudence in managing and investing in their endowment funds. And the Act really speaks to this standard with respect to kind of 5 key investment areas or concepts. And in some cases, these are really stated as duties, fiduciary duties. The first 4 of these, prudent person rule, investment diversification, reasonably suited risk return objectives, and reasonable and appropriate costs. I'll speak a little more on these in a minute. And then the last area, prudent spending, Dave's going to talk about that a little later in the presentation here, but just briefly on that, UPMIFA made 2 important changes in the area of endowment spending, changes versus the earlier law. And the first one, importantly, removed the historic dollar value floor on spending, and which basically that required that if an endowment, the value of endowment fund dipped below the original funding that created that endowment, then essentially it was frozen until the value recovered above that historic dollar value. So if you think of a $10 million endowment fund that has dropped in value to $9 million, essentially it was frozen from spending under the prior law. That UPMIFA removes that limitation. And then secondly, it provides 7 factors to be considered in making spending decisions and in creating spending policies. So next slide, Heather. Okay, so a little bit more on these first 4 duties related to the standard of care. That essentially UPMIFA codifies the first of the three main fiduciary duties that Dave spoke to earlier, and that is the duty of care. And it does so in the form of the prudent person rule, which essentially states that fiduciaries, those responsible for the management and investment of endowment funds, must act in good faith using the care standard of a prudent person in a like position. The Act also provides for delegation to agents. Those may be in-house committees or officers, or they may be third-party agents. It also speaks to the establishment of scope and terms of those agencies, and it applies the same prudent person standard to the establishment. And then it also speaks to supervision and monitoring of agents in their work in managing endowments. And really a best practice in this area is to have quarterly reviews of the endowment investments, especially if you've engaged an outside advisor to manage those assets. The agent has a duty of reasonable care, and then lastly, the agent is subject to court jurisdiction. And really importantly here, UPMIFA does provide that if organization leaders meet the good faith and prudence standards in delegating and monitoring the work of agents, the leaders are deemed not liable for the decisions of the agent. So essentially, this is part of that safe harbor aspect of the UPMIFA. Next slide. With respect to best practices and the UPMIFA standard of care with regard to investment portfolios, endowment portfolios, the first requirement is that the portfolio be diversified across asset classes, sectors, geographies, and the Act states that a lack of diversification is deemed imprudent unless there are really special circumstances. Secondly, the Act speaks to the whole portfolio management standard of performance, basically incorporating modern portfolio theory so that the focus is on the overall performance of the portfolio as a whole, not just one asset or a portion of the portfolio. Importantly, reasonable and appropriate costs are an obligation under UPMIFA, and that is sort of an all-in cost obligation. So costs of, say, advisory fees, but then also costs embedded in the investments themselves. Portfolio balancing is another requirement, and here we're really talking about an appropriate risk-return balance within the portfolio. And then there's a special skill standard of performance, essentially in-house or third-party agents are held to a standard consistent with their expertise. And next slide. So there we go. Just a few kind of best practices here as I wrap up and then pass the baton back to Dave. First one is keep minutes of meetings and decisions, basically document. And to ensure transparency of financial reporting, you want to provide regular updates to other committees within the church and obviously the vestry. Regularly review and evaluate finances and investment strategy. Here again, quarterly reviews are highly recommended. At the diocesan level, possibly consider fiduciary liability coverage. I will say in most states, unpaid volunteers, such as vestry members, are in most states are shielded from monetary liability by charitable immunity laws. An exception to that immunity would be fraud. Engage in ongoing periodic fiduciary training, particularly when you have new committee members coming on board. Have a written conflict of interest policy, which should be signed annually by officers, trustees, vestry members. And then we recommend seeking objective professional guidance from independent advisors. And then lastly, I will add one more, and that is read and become familiar with your state's UPMIFA statute. Possibly make that part of your periodic fiduciary training. Most of those statutes they're maybe 4 or 5 pages long. And with that, I will kick it back to Dave.
Great. Thank you, Bill. And Heather, next slide. We're going to spend a few minutes on investment policy statements and some of the key things in them. What is it? It's a document that outlines the roles, responsibilities, and processes for overseeing the endowment or the foundation's investments, and it addresses all kinds of procedural issues: who the parties are, what their roles are, how they select an outside investment advisor, how they can monitor it, and spending policies. And why is it important? The IPS is an integral part of fiduciary risk management. It takes you a long way. This single document takes you a long way towards fulfilling UPMIFA kinds of responsibilities in terms of fiduciary duties. And because it can be comprehensive and it outlines all kinds of procedures. I do think it's worth noting that if you don't have one, the thing to be avoided is if there's an individual on a committee and he's the only person managing the investments, and that person doesn't have a lot of guidance as to how investments are being picked or what they are. That's where one needs to be careful, and that's where investment policy statements can just be very useful. And one of the 2 or 3 key things in investment policy statements, which we'll get to, are asset allocation guidelines and listings of the funds or investments that your parish might have. It's a great place. Usually parishes will have unrestricted gifts, restricted gifts, temporarily restricted gifts, and a good comprehensive description of the history of those gifts that lives in your investment policy statement is a great way to sort of keep up with them over time, especially as committees change. Next slide, please. So before we get to the asset allocation, this is just a quick refresher slide on asset classes, and there are lots of them. And the basic categories are cash and fixed income, equity. There's also alternatives, which we'll talk about in a second. But in each one of these categories, there are several different kinds of sub-asset classes. And to Bill's point about diversification being important, it's nice to see and important to see sort of diversification across these asset classes. That can include a balance between active and passive management as well. And I think it's also worth reminding folks that in the investment world, there are only three drivers of returns: asset allocation, security selection, and market timing. And the institutional studies are quite clear that between 80 and 90% of returns over long periods of time are driven by asset allocation. So it's important to sort of think about that and stay focused on that. Next slide, please. So here is just a sample IP, target asset allocation grid. These come in all kinds of shapes and sizes, but they're usually characterized by a target weighting and then minimums and maximums, and then a listing of asset classes and potential weightings in those. And the listing of the specificity of those asset classes can be a little more or less specific depending upon committees' preferences. There are plenty of asset allocation tables that only have three kinds of asset classes: global equities, fixed income, alternatives, cash. So there's plenty of room for some flexibility there. The important point about this is it really helps keep the portfolio in the middle of the road. You can have different asset allocations for big different pools of funds within your entity. And there's usually also, and it's not usually in this table, but in the section on investments, it's important and good to have a list of prohibited investments, like the do not do this. And that again is a function of who's your investment advisor, what's the size of the pool, and it can be everything from no options, no leverage, no commodities, to no individual stocks. But there are cases where no alternatives, but there are plenty of circumstances where those can be appropriate as well. Next slide, please. So just a quick slide here on alternatives for reference purposes. The alternative asset class has seen tremendous growth over the last 10 to 20 years. And private market investments used to be the domain of very large pools of funds, university endowments, the big pension funds, but there's just been tremendous growth. And there are now strategies in different kinds of asset classes that are sort of alternative, that have varying liquidity. At the bottom there, you can see what are called liquid, people call them liquid alts, and they tend to trade in mutual funds and other kinds of commonly available investment vehicles. And they can include, real assets, real estate, hedge strategies. There's also in there the 1 to 5 years. Interval funds have become increasingly popular over the last 5 to 10 years as well. Then those tend to have quarterly liquidity. And then there's semi-liquid, and then there's very illiquid the illiquid 10 to 15 year things tend to require asset pools north of $25 million to get into some of the better performing ones. That's just and they vary by complexity, return expectations, and risk expectations. That's just a kind of a quick guide to some of the things available out there. Next slide, please. Selecting a spending policy. Bill was referring to this earlier. UPMIFA offers a range of factors. This is kind of a key building block. You have your asset allocation table and your spending policy, and they're both in writing. That goes a long way. The spending policies are super helpful in terms of budgeting every year, depending upon the size of the endowment or the funds for your parish. Those those funds can provide a meaningful part of your operating budget. And so the calculation of what those funds is going to provide early in the year before the vestry, is adopting the budget early in the year, early in the planning year, that's usually the fall, September 3rd, late third and early fourth quarter, is really helpful. There is out there occasionally, as Bill alluded to, a 7% spending guideline. The usual where there's a presumption of imprudence, the usual kind of range, I think, of sustainable withdrawal rates that many pools use is 4 to 5%, and that can vary. And that is a good sustainable withdrawal rate by many standards, and to think about. Next slide, please. Now, this is just a quick guide. There are different types of spending policies. And this lists 5 simple, inflation-based, moving average, corridor, hybrid. They are all out there. I would say the simple and the moving average are maybe the most common. The moving average really probably being the most common of all, where you pick your predefined percentage of assets, say it's 4.5%, and you do it for 3 or 5 years, 12 or 20 quarters, to kind of smooth spending between up and down markets. But these can be changed. There can be special needs for churches. There can be specific needs to draw on funds, and you might go above that in a particular year, and that's okay. But as Bill was saying earlier, document. If you are making an exception, get it in the minutes as to why. Next slide, please. Okay. Bill likes to close things with calls to action, like takeaways. It's a great idea. And we've tried to put a few things in here that were kind of top of mind for us. Number 1 on the list, have that investment policy statement. Heather also likes scary stories, and there are scary stories out there in charitable endowment and foundation land about people not paying much attention to their investment policy statements. Heather, what was the one you were telling us about recently? Some church in Michigan?
Yeah, that has an investment policy statement from 1992 that we were working on. So yeah, it's a healthy revisit process. So and there's no ill intent. It's just time gets away, and there are volunteers involved, and yeah, it's just not something that had been reassessed. But 1992 to 2023, not usually the timeline we want to see.
Yeah, and if you don't have a good investment policy statement, CAPTRUST has some good templates that we are happy to make available. Also, places like Vanguard will have some pretty good things available as well. So it's an excellent place to list and describe permanently restricted gifts. As we discussed, it's really important to honor those restricted gifts and spend them consistent with the intent that they were given with. There we have that written spending policy in the IPS, or sometimes if it's separately, keep the minutes, annual training. And then here, once assets endowments reach a certain size, it's great if you can work to retain an investment advisor who has experience with managing endowment and foundation assets. And that means a couple things typically, and sort of proactively managing asset allocations against the IPS. And in a perfect world, your investment advisor comes to you semi-annually or annually, and you look at this stuff quarterly and says, here's your IPS, here are your asset allocations. Guess what? Your asset allocations are consistent, or we rebalanced to fit into your asset allocations. And so they are proactive. You can have, it's not uncommon to have situations where parish endowments, they start small and they're in a local retail environment, a very informal environment, but then they end up growing through a major gift of some kinds. And it's like, we need to take our game to the next level. And finding advisors that can do that can be very helpful. One way to do that, the traditional way to do that with larger pools, is RFPs, requests for proposals. And it's a bit of a drill, but there are very clear processes for it. In fact, CAPTRUST has a very clear and helpful steps to do this kind of thing and how you do it. The normal rules on this, or the normal guidelines, are for good hygiene is every 5 years or so ago. But I would also say it's just, you don't have to do it, but think about it. I mean, in our particular parish, we have had the same advisor for 10 or 15 years, and the light went on. It was like, we should look at an RFP, but we made a careful analysis of our market and what was available in our market. And we decided for the time being to take a pass and not do an RFP, but we did think about it and we documented it, and away we went. Finally, I think that making some effort to grow your endowment by just letting parishioners know about it, that can be a great thing. And if you can let your parishioners know that you have investment policy statements, that you have a good advisor, that can be encouraging and can encourage legacy gifts. Another sort of Episcopal Church piece is that the church does have some great resources on legacy societies. And our parish started a legacy society a couple years ago, and it's been a helpful thing. So I think those are the main points. And now it's time for Q&A. And let's see. Heather, have some things come in?
Yes, we have a number of questions, and just for ease of doing business, I think I'm going to start with the most recent and work backwards. Will you share a couple church IPS samples via email?
Yes, absolutely. We'll get you I think the best one to share is our CAPTRUST template, and we'll get that too. We'll get your email, get it to you.
Perfect. Will you please speak to the balance of fiduciary responsibility and values-based /ESG socially responsible investing considerations?
That's a great question. Maybe I'll start and Bill and Heather can chime in. There are enormous resources being devoted to ESG type investing and various styles, and it is a big topic. And the Episcopal Church is working through this as well and has certain guidance, I would say, and has afforded parishes and dioceses great flexibility in how they address or do not address ESG type issues. The Catholic Church is very different, and CAPTRUST is very active with the Catholic Church and the investment of funds there, and they have a very top-down prescriptive approaches. There's different kinds of ESG. I would say where we are in our diocese is you got to think about it in terms of your fiduciary responsibilities. And so what we're doing this year in our diocese is we are hosting some conversations with outside experts on ESG to try to form our views about it. Bill, maybe you got some thoughts there too. Heather, yeah.
Answer, yeah, they're definitely not mutually exclusive. In fact, they in many respects can be complementary.
It's a tough conversation, I think, unless you're given mandates by the Episcopal Church to create alignment amongst your board and your decision makers, among your committee, about what does that mean? You know, what does ESG or socially responsible investing mean? And I think it's been a challenging ride, especially last year for organizations that carved out asset classes that were the only things that performed well. And then you were left looking at your strategy going, well, we missed. So, I think it's, we're seeing, we do an annual survey of endowments and foundations, and 2022 really saw a step away from some of those discussions, but we can certainly help with that. I don't have the right answer for you necessarily, but we can help. Let's see. Another from Q&A, we want and need to offer training to our trustees. Where do we find good training modules?
Well, that's a great question. What we've developed, I would say CAPTRUST noticed sort of an absence of good training modules and training information in the market, as it were. It's just not a topic that's really talked about enough, just even in terms of basic fiduciary duties, basic conflict of interest avoidance, all that. And so, the presentation that you're seeing today is actually CAPTRUST's response to this perceived need for good training manuals. And please, we would encourage you, please feel free to share this, these slides, this deck with people on your boards and committees as a way to talk about it. And I mean, Heather, have you got other thoughts there?
Well, these are excerpts, what we're sharing today. The entire deck is 73 slides, I think. So there are a lot of other topics that we cover. We just didn't think you'd want to sit through 73 slides in one sitting, and it's a lot of content. So, certainly, we can help, or engage with your investment advisor and ask what they have available in terms of quarterly training. It's super important. And there's a real lack of content out there. ERISA is so much more robust and legislation, and there's new content, and accountability is a little different. So UPMIFA is different, then each state has their own read on that too. So it's a challenge for sure. Okay, the next question. You guys are gonna have some good questions here. Thank you. Does a call to boycott a specific industry or company have any impact on fiduciary duty? And I think this is still kind of falling under the ESG conversation.
Say that again. Could you repeat the question?
No, I'm sorry. Does a call to boycott a specific industry or company have any impact on fiduciary duty?
I think it does. It raises an issue to kind of consider. I don't think I think it should be thought about, and it should be addressed. I don't think it means that you have to, go with the call to the boycott, but it merits consideration as part of your overall approach to ESG.
Yeah,
And I think they're all things document decision-making process.
Documented, and I'll chime in there too, is that's a conversation to have with your advisor or the people who are managing the endowment, because if you're talking about excluding industries that say represent a material portion of, say, an index, then that's going to have a significant impact. But if it's a company or two, then that's a different situation.
Okay, next question. Other than Google, what's the best way to access the UPMIFA standards?
There is UPMIFA. There is an up. Google is actually a good place to find the original, the statute itself, and the commentary that the commission or the conference rather had to go along with that. But there is an upmifa.org website, and I haven't looked to see if they list individual provide copies of state statutes, but
Yeah, you can also look up your state's individual statutes.
yeah, look up your individual
If
statute.
you go ahead and Google your state, like if you put in, Virginia Uniform Prudent Management of Institutional Funds Act, it boots it right up. I mean, it's like Title 64.2. Google's gotten pretty good on this stuff. It lists the statute and you can just print it out.
Next question. We have a couple of endowments where we track the initial principal as permanently restricted and any amount above that is temporarily restricted. Do we need to maintain that distinction with the new UPMIFA?
Hmm.
Kind of an accounting question, actually, too.
Yeah, I would think that that's something that has to be addressed pretty explicitly in the IPS.
Yeah, I would say good idea. You're not filing 990s, but you should operate as if you were. And so if you're interacting with the CPA and you've got board restrictions, if you do or don't do an audit, I think it's probably a good idea to note that. All right. Why did New York pass its own rule? Who knows?
They do a lot of things. They do a lot of, kind of like California. New York has a lot of its own ideas about things and is a gigantic, concentration of financial assets.
David Lucy makes a great point that's worth reiterating. The 7% rule does not mean that all withdrawals below that level are prudent, only that withdrawals above can be deemed imprudent by definition.
Yeah.
Good point.
Yes.
Correct.
Good point. Well taken.
Let's see. There was a question about, Dave, I think it was during your section. Can you restate the 3 areas you listed quickly? Asset selection, timing, and then there was one other area.
Oh, yeah. Asset allocation, security selection, market timing. And those are the key things. And, in a slightly different vein, it is important to manage costs in this whole environment. And again, this is like the rule of 3s. There's really usually just 3 levels of costs in your whole investment program. There's trading costs that relate to the buying and selling of investment vehicles. Then there are costs associated with mutual funds or ETFs or other kinds of packaged investment vehicles. And then the third level of cost is if you have an investment advisor and they are adding fees to those things. And so try to, as good fiduciaries, you want to kind of look at each of those levels of fees. It's worth saying that I think that the models for the delivery of investment services have evolved terrifically. It used to be that, buying and selling an individual stock, what you could spend enormous amounts of money trading individual stocks. That has kind of gone by the boards. And if you're in a major custodial environment, a Schwab, a TD Ameritrade, a Vanguard, the cost wars there have driven trading costs to almost zero, actually zero, for ETFs and individual stocks, maybe a small fund for mutual funds. But you do have to be careful about the fees in actively mutual funds that are out there. There are things called sales loads, which you never want. And then the expense ratios of those funds you want to look at. And it can be a little harder to get underneath. And the quality of those funds can be a little tougher to kind of pull the hood up on that. But I would also say that's something out there to be cognizant of. And it's also worth asking your advisor. It's amazing how many people don't, that's not common in innovation. It's like, what are our fees? How much does all this cost? It's okay to ask your advisors that and at least see what kind of an answer you get.
Yeah. All right, next question. Does allocation of assets to a mutual fund or ETF of alternatives, private equity, venture capital, real estate, or a mutual fund or ETF of fixed income fully count as allocation to that class? Because holding a traded fund is not the same as holding an individual security.
If I understand the question, I think the answer is yes. You know, if you invest in a fund, whether it's an ETF or a mutual fund or separately managed account strategy that is focused on fixed income, then that is a part of your fixed income allocation. Or again, if it's a type of alternative strategy, or if it's an equity strategy. And of course, within those big asset allocation categories, there are many subcategories. But
I might chime in there too, that can be difficult. That can take extra work to sort as well. Traditional brokerage statements can be very unhelpful in trying to sort out what your asset class allocation actually is. Many brokerage statements that we see, all they tell you is how much you have in mutual funds and how much you have in ETFs. And there's a little pie chart, and it's like, that's what you got. And like, that's not your asset class allocation. It's your investment vehicle allocation. And then there are different mutual funds that sometimes have stocks and bonds in them too. So that can require a little extra work to kind of get under the hood on that sometimes too. But yes, different things, different kinds of vehicles can count towards the same asset class, if that was the question.
Thank you. Another question, when you state we should encourage donations to grow the endowment, is it appropriate to ask for current gifts to the endowment or only future gifts such as through bequests?
That's a great question. Sort of, I mean, I would say you can take a step back and you can talk about current giving, major gifts, and legacy giving. Major gifts current giving runs the operating budget of the church. Major gifts tend to be more oriented towards specific capital projects that are going on. And so they often live there, but there can be, it's regular and not uncommon to get major gifts on a current basis. We got a new organ in our parish, and suddenly someone gave $10,000 for the care and upkeep of the organ. And then another person gave another $10,000 for the care and upkeep of the organ. So I would say, don't foreclose yourself. Legacy giving is not, the only way to begin to grow the endowment.
Okay. Next question. When can the corpus be used for investment in the future of the church while holding in mind the founding donors' commitment to ye old Episcopal Church?
Let's repeat the question, Heather.
Yeah.
There's a couple pieces in there.
Yeah. When can the corpus be used for investment in the future of the church while holding in mind the founding donors' commitment to ye old Episcopal Church?
Okay, that's a great, call your lawyer question, because you need to be clear about the donor's intent. I would say push back to see what this, if the donor just said ye old Episcopal Church, I think, our own parish has had some interesting stuff along those lines, and we actually have had legal counsel involved to provide some guidance on, what's a reasonable interpretation of that kind of clause. So I would say, try to develop the intent of the donor, and sometimes the intent of the donor needs to be adapted because situations have changed, like maybe ye old Episcopal Church isn't what it used to be. But that's a get help thing.
Okay. Next question. Do you have a template for an RFP for an investment advisor?
The answer is, Heather, you're really good on this one. We do, and the template for the RFP is also there's a process with multiple steps, and the RFP document is a part of that. And I will be happy to get you the RFP and some of that. That would be, if Joe wants to invite us back sometime, that would actually be a good session to do an RFP kind of overview drill. But we can get you that document and some of the supporting materials.
We typically also publish a webinar annually, and we can send a link to that as well, in addition to the actual RFP template. Let's see, we talked about this. So we'll be recording.
These are really great questions.
Yeah. As church attendance and giving is in decline, what is and is not appropriate use of the endowment fund?
I think, I can only sort of speak from my experience here, is that is an issue to work out at a couple levels. One is the donor intent behind specific gifts. And if there's clear donor intent behind specific gifts, that needs to be respected. But then the balance from operating the church perspective, the amount of your endowment that goes to the operating budget, as opposed to, say, outreach, that's really a discussion for the vestry to balance, some of these interests in light of the environment.
What's involved in establishing an endowment society?
Legacy society.
Legacy societies. Okay, it was written. Okay, I believe it would be beneficial to offer transparency of the funds and structure around how the gifts are used.
So legacy society materials are available from the Episcopal Church, and I can't remember the name of that little area of the Episcopal Church that has that. They're up in New York on the Upper West Side. A lot of great stuff. But I agree, transparency about gifts is important, and I think the investment policy statement is a great place to be clear. My experience is that there's a lot of silo problems in parishes about who knows what, and it creates a sense of a lack of transparency. And so if your investment committee or your finance committee can be clear with the vestry about things, maybe publish something once in a while with the parish that comes out in the fall that says, here's our investments and here's how they go. Those can be steps that help create transparency, because there can be a lot of confusion. You can have parishioners, and this happens to us, it's like, oh, you have a good endowment, why do I need to give? And you don't want to end up in that place.
Okay, wrapping up here. Do you think the unrestricted portion of the endowment corpus should or could be used for the church capital campaign? Giving up income to support the church is only part of the issue.
I think the short answer is, if it is unrestricted, then the vestry has the authority to use those funds in its best judgment on behalf of the church, and that they could be used for more sort of building related things.
Okay. We are right. Go ahead.
Sorry? Is that
right at the top of the hour?
okay?
And I think I may have missed one or two. I hope not, but I think we've run through questions. And there are a number of resources that folks have added to the chat as we've talked to, so feel free to check those out.
That's terrific. Well,
UCF.org.
I would like to close with a huge thank you to our audience and to everybody who's on this call, because It takes time, it takes effort, it takes initiative to sit in webinars and hear people like us talk about things. But if you're doing that, that's great work. Thank you. You know, the Episcopal community is a wonderful community, and what Joe is doing through the Episcopal Parish Network is really exciting to be a part of. So we hope this has been helpful. We hope there's been a few nuggets out there for folks, and maybe we wave goodbye.
All right.
Maybe Joe
Thank you.
will maybe Joe will close this.